Topic 5, it's a source of finance. Now, what is the meaning of source of finance? Source of finance means when company going to raise money, what options company has to raise money? How can company collect money to start and run the business? Right? We have studied previously that normally capital is amount of money that company need to start and run the business, right? So generally we study that capital involve debts that's come through the bank loan or come through the bonds, and equity, which involve selling stocks or selling shares. So that's mainly source of capital that company has. But in this topic, we're gonna have a look all kinds of source of finance that company use it to raise money, not simply just selling stocks or borrow money from bank as a bank loan. All right, company has a various kinds of options available to raise money time to time to maximize its investment or productivity or whatever, right? So what does it mean, source of finance? Source of finance means how does company raise money? How does company raise money? What options company has to raise money? All right, what options company has available to raise money? So company has mainly two options or two different ways to raise money: internally and externally. Internal and external. Internal means within the company. Another name of internal source of finance is a organic source of finance. Organic source of finance. And another name of external is inorganic source of finance. Inorganic source of finance. Inorganic. So organic and inorganic. Now, what does it mean, organic? Organic means when company raise money without taking any support from outsiders. Without support of outsiders, without support of external parties, when company generate or raise money at its own level, we call it internal source of finance. All right. So internal source of finance means organic. Organic means without external support. Without external support. Without external support. That's actually the meaning of organic. So another name of internal source of finance is the organic source of finance. All right. And external source of finance, with the help of external parties. External parties. External parties means outsiders. When company taking help from the outsiders, this is called inorganic source of finance. All right. Now, start with internal or organic source of finance. Now, what are the options company has available to raise money organically? Can you tell me, how does company raise money without taking support from the outsiders, without borrowing money from outsiders? Can you tell me what options company has available? How does company raise money from outsiders? Can you tell me what options? Maybe internal sales preference stocks. Sales preference stock is an outsider. You selling stocks to the outsider to raise money. So preference stock is not internal, it's external. You're taking support from the outsider, you're taking support from the shareholder to raise money. Another one is invite people to, again, invite people to buy stocks. If you are inviting people to buy stock, then that's also external source of finance. You're taking support from the outsider to get money. You're raising money from the outsiders. So again, selling stocks or invite people to buy stocks, that's also not organic. You're not taking help from the outsiders. You know, outsider users, external users. So shareholders are external users. So tell me, any other? Any other options that company has to raise money? No? So start with the first, external source of finance. So the first external source of finance is, sorry, internal source of finance is selling product and service. When company going to sell its product and service among customers, that's called internal source of finance. You're raising money at its own level, right? Yes. So first is selling product and service. And second one, sell assets. That's right. Selling assets. So remember, when we talk about selling assets, we're gonna sell those kind of assets which are not in use anymore. You're not gonna use any kinds of assets that you are currently using to maximize your productivity. That asset that you are using to run your business or to generate your operating activities. All right. So we're not going to use those kinds of assets. So we're going to use some kinds of assets that not in use anymore. It's just assets you are not using. You are not generating any money using that asset. So better you sell it. And whatever money you will receive by selling assets, you will invest in your business. That's normally what we do. We invest money to raise, we invest money by raising money. That's exactly we are doing by selling asset. All right. So this is the second source of finance, organic source of finance. Right? What is the next source of finance that company has? Any other third one, organic source of finance? Go to invest. If you want to invest, you need money. How we raise money? What do you mean by go to invest? If you want to invest, you require money. But I don't understand what you said, go to invest. Can you explain to me what do you mean by go to invest? Invest, give company more money. How? How invest give company more? You mean the return on investment? Invest, give company more money. What do you mean by invest company give more money? You mean the return on investment because you invest money and you make money? That what you mean? No, we are not discussing about the return on investment. Let me explain again. Maybe you misunderstood about the source of finance. So if you want to start a company, right? What do you need if you want to start a company? What do you need? You need money. Yes, you need finance, right? And the question is how we got finance, how we can have money. So let's say we have money using this source of finance, that what we are discussing right now. Once you have finance, what do you do with this finance? What do you do with this money? What do you do with this money? You have money, right? Once you got money, what are you going to do next? Tell me, if you get money, what you will do with that money? Invest. Yes, you will invest. You invest that money. Now the question is where you will invest. Where are you going to invest? You will buy assets. Buy assets means, like you mentioned, buy land, building, plant, machinery, equipments, material, right? We also call resources. We acquire the resources. When you acquire resources, means you buy assets. Buy assets means invest money. So remember, when you raise finance, this is called inflow. Cash inflow, right? Cash inflow. And then you invest. That's called cash outflow. Cash outflow, right? And once you invest, then you will start production. Start production means you selling, you producing product. That means cost. right? And after your production, you sell your product. This is called sales, right? And sales minus cost is profit or loss, right? That's exactly happen in a business. That's the complete picture of business by focusing on the money. So my question, what we are studying right now, we are not studying about this. This is all about later. We are studying this one right now. How we have a finance. How can we have finance? So we have a source of finance. Source of finance. Source of finance means we have these options to raise money. Two options, internal, external. So remember, we are not talking about investment. We are not discussing about investment. Investment is a later step, but we have to raise money first. So that's why some students write down, I think invest, give more money. Yes, invest, give more money. But if you need to invest money, you must have money. And how can have money? Through source of finance. That's why internal source of finance and external source of finance. Did you understand the clear picture of this topic, topic 5? Okay. So now we go back to internal source of finance. Selling product and service, you raise money, right? Later, maybe you raise money later, but not at initial level. So this is later, like here. This is later step. But again, we do not need money only when we start the business. We do not need money only here. We also need money time to time, right? When you already started business, maybe you need money next year. You need money next to next year. So this selling product and service may not be at this level. It may be later stage. But again, this is also source of finance. All right. Selling asset, whatever assets you are using that's not in any use. So you can sell assets to raise money. Again, that's also later step. Because if you want to sell assets, you must have assets, right? So this is selling asset. What could be the next source of finance? Any other source of finance that company has to raise money? Another source of finance that you may study in your financial accounting class. You may study it in your financial accounting class. That is retained earning. Retained earning. Anybody knows the meaning of retained earning? Any idea what is retained earning? Do you know what is retained earning? Say something. Financial accounting or accounting subject? No? Nobody knows? Okay. So let me explain you what is retained earning. So you know that companies sell product to raise money. This is called revenue or sales, right? Minus cost. Whatever money we spend to produce and sell product, that's called cost. Then you got profit. From this profit, you have to pay some other expenses, like as interest, minus tax, and minus dividend. I hope you know that. This dividend, it's for preference shareholder. All right. So after paying dividend to preference shareholders, we got net income or net profit. Net income. Now from this net income, we're going to minus dividend again. Dividend for who? Dividend for common shareholders. Common shareholders. After you minus dividend to common shareholders, whatever money left at the end of the period, after subtracting all kinds of expenses, all kinds of costs, whatever money left at the end, that's called retained earning. Retained earning. Now, how does company increase retained earning? What does it mean, retained? Retained means something company keep or something left. Left or keep. For what? Why company keep that money? What is the reason to keep this money? Keep this this earning. The purpose is reinvest. Whatever left at the end of the period, company reinvest where? Reinvest in business, in project, buying assets or investing in any other different project. That's normally the idea here. So reinvest. So it means the money left, reinvest. Reinvest means invest again. So means this retained earning also known as finance. All right. This retained earning also known as finance. So always remember, this retained earning highly depends upon your common shareholders' dividend. Now, in order to understand this common shareholders' dividend and retained earning relation, we have to go back to the previous topic, topic 4. Remember, in topic 4, we study about common stock valuation method. We study 4 different common stock valuation method: basic common stock valuation method, constant growth valuation method, non-constant growth valuation method, and zero growth valuation method. So in these 4 methods, you can pick 2 methods, which are constant growth valuation method and non-constant growth valuation method. Now, again, I repeat, constant growth and non-constant growth valuation method. Now, what happened in this growth valuation methods? In this growth valuation method, company do not pay dividend to shareholders. Company take their dividend back, company take it back, and company reinvest. But before reinvest, you have to inform the growth rate to the common shareholder, right? Remember, we also use the growth rate under this constant growth valuation method and non-constant growth valuation method. The formula is a D1 divided by R minus G. D1 is a D0 multiplied by growth rate, right? That's become D1. So D1 divided by R minus G, right? So that is your constant growth valuation method. So we, instead of giving dividend to common shareholder, company keep that dividend and company reinvest. Company reinvest, like here, reinvest. So when company will pay them less dividend, your retained earning will increase. Retained earning will increase, so company has more money to reinvest. So that's why retained earning also known as source of finance. But again, remember, this retained earning increase when you do not pay dividend to shareholders, right? So technically, this money belongs to equity. That's what you study in your financial accounting, right? What inside the equity? Equity means whatever money left at the end of the period, that money belongs to the shareholders, right? So technically, this retained earning is the equity, all right? But this is not just the equity. This is called internal equity. All right, whatever left inside the company, that technically belongs to the shareholder. That's why another name of equity is the residual interest. All right, I hope you also know residual interest. Residual interest that we also study in your financial accounting, right? So whatever is left at the end of the period, so retained earning also known as the residual interest. So means we can say that retained earning is the equity. This is internal equity. So retained earning has another name. We also call it internal equity. That is your retained earning. Did you understand that? You understand? Yes or no? Is that okay? Is that clear? Okay. So can we move on to the next? Okay. So let's move on to next. Now, internal source of finance are finished. So we have three internal source of finance: selling product and service, selling assets, and retained earning. All right, so another name of retained earning is a internal equity. So this is the reason behind retained earning. That's your, so this is your recall financial accounting. Financial accounting and common stock valuation method. Common stock valuation method. So that if you remember your financial accounting, that's great. If you don't, so just keep in your mind common stock valuation method. All right, so now let's move on to the next, which is external source of finance. Now, here we're going to discuss about external source of finance. Whatever you have explained me before about like selling stocks or invite shareholders to buy stocks, yes, these are the external source of finance. So it means company is taking support from the outsiders to generate funds. All right. So now this external source of finance divided into three different parts. So we have three different types of inorganic source of finance. So in these three parts, the first one is short-term source of finance. So it means company raise money for shorter period of time. So obviously maximum 1 year. Second one is a long-term source of finance. So long-term source of finance means company is raising money for more than 1 year. So the maturity period or payback period is more than 1 year, 3 years, 2 years, 5 years, 10 years, right? So this is called long-term source of finance, external long-term source of finance. And the third external source of finance is others, means some other companies are helping us to raise funds, not directly raising funds, but acquire some kinds of resources. So the best example for other external source of finance is merger and acquisition. We call it M&A, all right, merger and acquisition. So we will discuss about 3 different kinds of mergers under these other types of external source of finance, like horizontal merger, vertical merger, and conglomerate. All right, so 3 different types of source of finance we have under this external source of finance, right? So here, so we have 3 different types. Two, 3. So we have short-term external, long-term external, and we have others. Right? So we have 3 different kinds of source of finance here we have. Now, start with the first one, which is short-term. Short-term means maximum for 1 year. 1 year. So it means you have to return back within a year. Whatever money that you are acquired through this short-term source of finance, you have to return money within a year. So maturity period is maximum 1 year, less than 1 year, right? But maximum is 1 year. Long-term is minimum 1 year. So this long-term external source of finance is minimum for 1 year. So you take at least 1 year. So more than a year, you have a time to return. Depends upon the contract that you are entering with your lenders, right? And others involve M and A, M&A. M stands for merger. And A stands for acquisition. Merger and acquisition. So that's your external other source of finance. So let me look. I'm also sending you these 2 files so you can keep in your computer system. So now we will start with short-term source of finance. So we have around 6 to 7 short-term source of finance here. You have around 7 source of finance, short-term. And long-term, we have 1, 2, 3, 4 to 5. And others, we discuss about 3. Let's start with the first short-term external source of finance. So the first short-term external source of finance is a short-term bank loan. We are borrowing money from bank for shorter period of time. So obviously for maximum 1 year. So when you borrow money from bank for maximum 1 year, that's called short-term external source of finance, right? Short-term bank loan. So borrow for maximum 1 year. When you borrow money from bank for maximum 1 year, that's called short-term bank loan. All right. Now next, short-term external source of finance is a hire purchase. Now, what is the meaning of hire purchase? For example, you go to buy a laptop, right? And the price of laptop is, for example, $1,000. So you go to the shop, you check the price, which is $1,000, and then you look at your bank balance, you look at your pocket, that currently you have only, let's say, $300 in your pocket. So, but now the question is, the price of laptop is $1,000, right? But right now you are having only or maximum $300. So the question is, can you buy a laptop? So answer is, it depends upon the service that shops are offering hire purchase service or not. Now, what happened under hire purchase service? Under hire purchase service, still you can acquire or you can buy the assets even though you are not having a full money. So same example, right now you are having a $300. So now what going to do? You will give $300 or whatever is the minimum amounts required by the shop. So let's say amount required by the shop is at least $250. This is called down payments. So you will give these down payments, which is $250. And rest of money, which is $750, you have to pay that money in installments. In installments means in parts. So pay installments. Installments means pay in parts. Pay installments to acquire or buy the asset. All right. So what are you going to do? You pay $250 and the rest of money, which is $750. So now that money you have to pay in installments. You have to pay in parts. So it depends upon the shops, how much they want every month from you. Let's say $50 every month. All right, or maybe $100 every month. So let's say $100 every month. So you have to return that $750 in 7.5 months. All right, it will take another 7.5 months to become an owner of that assets. But during that time, still you can use that assets, and every month you have to pay installment. That's the meaning of hire purchase. Why we call it hire? Hire means rent. What does it mean, hire? Hire means when you rent the assets, hire. Rent means regular payments. Regular payments. And purchase means you buy assets. So now what does it mean, hire purchase? Hire purchase means using this regular payments when you buy the assets. That's called the hire purchase. Right? through this regular payment system, which is called installments, right? Installment is your regular payment system. So through this installment method, when you acquire the assets, that's called hire purchase. Can you tell me, is it happening in Vietnam, right? Have you heard about it before? Tell me, is it happen in Vietnam or it doesn't happen? Have you heard about this before? Student, can you hear me? Say something. So you know that, right? Okay. So this is called the hire purchase. So I don't know what you call in Vietnamese, but in English, they call hire purchase. So you are hiring assets by making every month installments, all right? So this is the hire purchase. Second, external short-term source of finance. Now let's move on to the next. The third, external source of finance. Third external source of finance is a trade credit. Trade credit. Now, what does it mean, trade credit? Trade means business. Credit means without cash. When you do a business without cash, when you buy and sell things without cash, that's called trade credit. Technically, when you buy product without cash, or you buy any material or any supplies without cash, that's called trade credit. The question is, you do not have enough cash, or you don't have cash to buy material. Can you buy material without cash? You don't have money, you don't have cash. Can you buy material without cash? Yes or no? Yes. When you buy material without cash, what do you call it? What do you call it when you purchase material without cash, or when you purchase material on credit? What you call it? We call it credit purchase. And credit purchase leads to accounts payable. I hope you heard this accounts payable in your accounting or in your financial accounting class. What does it mean, accounts payable? Accounts payable are those people from whom we purchase material on credit. So that's why they are become your accounts payable. You have to pay them money. Another name of accounts payable is a creditors. I don't know, you know accounts payable or you know creditors, but that's the meaning of trade credit. But the question is, this trade credit is giving you money? No, of course not. They are not giving you cash. They are lending you a material. You are borrowing material from them, and you don't have to return material back to them. In exchange of material, when the due date will come, you will return to them a cash. That's called trade credit. Trade credit means when purchase material or supplies on credit. On credit means without cash. without cash. Without cash. That's the meaning of credit purchase, and credit purchase also your short-term source of finance. Why short-term source of finance? Again, this credit trade credit means accounts payable or credit purchase. Accounts payable or credit purchase. So these, if you remember your financial accounting, accounts payable are your current liability. Current liabilities means any kinds of liability that you need to pay off within 1 year. That's why short-term source of finance. So current liability means short-term liability, right? That's the meaning of accounts payable or trade credit. According to financial accounting, in financial accounting language, we call it accounts payable, but in finance, we call it trade credit. Right? Is that okay? Understand? Is that fine? Say something. Yes, okay. If it's okay, so now let's take a break. So after break, we will continue with these short-term source of finance. So we can have a break. I'll see you soon. Thank you. Okay, so now we continue with the next source of finance, which is factoring accounts receivable. Factoring accounts receivable. Now, what does it mean? Factory accounts receivable. In order to understand factoring account receivable, we have to understand what is the meaning of accounts receivable. So accounts receivable are opposite of accounts payable. So accounts payable, the people to whom we have to pay money, right? And accounts receivable, the people from whom we have to receive money. So how accounts receivable arise? When you sell product on credit, that's called accounts receivable. Sell product on credit to customers, and those customers become accounts receivable. All right. So now what does it mean? Factoring accounts receivable. Under factoring account receivable, the meaning of factoring account receivable means when you mortgage your account receivable to borrow money for shorter period of time, that's called factoring accounts receivable, right? So factoring account receivable means when company mortgage their accounts receivable to borrow from bank for shorter period of time. All right. When company mortgage their account receivable to borrow from bank for shorter period of time, that's called factoring account receivable. Now, how does it work? So let me explain you through the small diagram how this factoring account receivable work. So let's say this is a company, right? C stands for company. Company sold product to customer, right? Company sold product to customer on credit. So credit sold, right? So this person become accounts receivable, all right? This person become account receivable. Account receivable means you have to receive money from this person in future. For example, you will receive money, let's say you sold product $1,000, right? So you will receive $1,000 from this person, let's say after 3 months. You will receive $1,000 after 3 months. So after 3 months, this person will give you cash back. Customer will give you cash back, right? Now, for example, 2 months already passed. So now 1 more month left to receive money from account receivable, but still 1 month left. So you call your account receivable and you ask that whether can you give me money now or not. And account receivable will have a look at the contract, and the contract says that still 1 more month left, but company needs money now. Let's say company need around $800 because company looking for some investment opportunity. Company has an investment opportunity to invest money, but company doesn't have money. So that's why company call account receivable to give them money. And of course, account receivable will say no, because time hasn't come. So what company will do in this situation? Company will go to the bank. Company will go to the bank. Company will mortgage their account receivable to bank. Company will give account receivable to bank, and the value of account receivable is $1,000. So company will mortgage account receivable to bank, and in exchange, after evaluating the market value of account receivable, company decided, bank decided to give $800 loan. Bank decided to give $800 to company. Let's say for 1 month. 1 month. All right. Now, if within 1 month, if company return this $800 back to bank with interest, obviously, whatever interest bank gonna charge. If company will return this $800 back to bank on time, which is 1 month, bank will return this $1,000 account receivable back to company, and company will receive money from this person after 1 month. This is the one situation. Second situation is if company do not return this $800 back to bank. Now what bank will do? Bank will not return this account receivable to company. So bank will contact this account receivable, and this account receivable will give money, which is $1,000 to the bank. So means bank is lending $800 and bank is receiving $1,000. So obviously bank has a $200 profit. This kind of system or process called factoring account receivable. So what is the conclusion here? The conclusion is company mortgage its account receivable to the bank to borrow money. If before maturity period, before expiry dates, before the final date, if you return your money back to bank, bank will return your account receivable, and now company will receive money from account receivable. This is the one situation. Second situation, if company do not return money back to bank within a time period, then bank will take control over account receivable, because bank has a rights, because bank has account receivable documents. So bank will, on behalf of company, bank will collect money from account receivable, and bank will keep that money. So that's we discuss here. Company has a bank has a $200 profit. This kind of process called factoring accounts receivable. Remember, factoring, not factory. Where factory is a manufacturing. This is factoring, factor, right? Factoring account receivable. And you can see that this factoring account receivable sounds like borrow money, but short period of time, because obviously same thing. What is the maturity? What is the account receivable time period? Account receivable time period, again, according to financial accounting, account receivable is your current assets. And current asset means short period of time, short-term assets. Obviously, the life or the days to receive money from account receivable is less than 1 year. So that's what this is called, factoring accounts receivable. Is that okay? Did you understand? Did you get it? Factoring account receivable? Student, say something. Can you hear me? Did you understand factoring account receivable? Please answer fast. Don't let me repeat the same thing again. Yes, well, I don't know, why do you take too long to answer my questions? So factoring account receivable is finished. Now let's move on to the next, which is commercial credit card or bank overdraft. Commercial credit card, or we also call it bank overdraft. Now, what does it mean, commercial credit card? It's same like as credit card. Now, but this credit card is a little bit different than the credit card normally you and me as a retail customer, we get it from the company. So obviously there are two types of customers bank has, retail customers and the commercial customers. Retail customer means like it's you and me, individual, right? Commercial customer means companies, when companies open their bank accounts in a bank. So again, depends upon companies to companies, depends upon customer to customer, bank issue a credit cards. Now, what happened in the how credit card works? In credit card, bank give you a limit. Let's say bank is giving you $10,000 limit. So it means you can withdraw or you can use this credit card to purchase something which value up to $10,000. So let's say you use credit card and you spend $8,000 using your credit cards. You did some shopping. You made some purchases for your business. Maybe you purchase material, you purchase assets, and you purchase some supplies for business purpose using business credit card, commercial credit card, right? Company credit card. You use it, that credit card, for company purpose. And let's say you spend $8,000 from that credit card. Now it depends upon bank to bank. Let's say bank is giving you 3 months period. So bank is giving you 3 months period to return money back to bank, which is $8,000. If you return this $8,000 back to bank within 3 months, that's fine. Bank will not charge any interest. So it means you simply borrow without paying any interest, interest-free borrowing. That's the one situation. And the second situation is, if you do not return money, which is $8,000 to bank on time, what will be happen? That in this situation, bank going to charge very high interest, maybe 20%, maybe 25%, maybe 15%, depends. It's very high interest compared to the normal borrowing. So these kinds of process, this kind of source to raise money, it's called commercial credit cards or bank overdraft. When you're using $8,000, that's called bank overdraft. Now, the name of bank overdraft is a negative cash. When your company has a negative cash, when your cash accounts in the minus. Minus means you have to return this cash back to bank, $8,000, because you borrowed from bank as a credit card. So another name of commercial credit card is unsecured loan. Unsecured loan means you do not mortgage anything for your credit cards, but still you borrow money from bank. So this commercial credit card called as unsecured loan. But here, like we discuss here, short-term bank loan or factoring account receivable, borrowing through factoring account receivable, these are the secured loan. These are the secured loan. And this commercial credit card, this is unsecured loan. Unsecured loan. What does it mean, unsecured loan? Unsecured loan means when you borrow without mortgage anything. And that's technically you are doing here. You're borrowing bank money without mortgage anything. So keep in your mind that these kinds of credit cards or commercial credit cards or retailing credit cards are not issued to all kinds of customers. It depends upon the goodwill of the customers. Obviously depends upon the loyalty of the customer, which means how long has been this customer is connected with the bank, right? For how many years, and how often cash in and out from this bank, from this person bank accounts or the company bank accounts, or how much money this company bank accounts keep all the time. So there are various factors to measure the customer loyalty or customer goodwill, or you can say that customer credibility. Right? So there are various factors. So after analyzing each customer credibility, bank decide to give credit card with the specific bank limits. It's not always $10,000. That example I give it to you. It depends upon companies to companies, bank to bank. Maybe companies giving you $50,000 credit on your credit cards, so you can use that $50,000 from your company as a credit card. All right. So this is called commercial credit card or bank loan, bank overdraft, and this is unsecured loan. Again, unsecured loan means you do not mortgage, right? You don't mortgage anything to bank. So obviously bank is giving these credit cards to the limited customers. So did you understand commercial credit cards? If yes, then we stop here. All right, but again, short-term external source of finance hasn't finished. We have total 7. So we finish 5. So 2 more, which are building societies and operating lease. So these 2 more short-term source of finance we will study in next lecture, in the next class. All right. So any question? Any question regarding this short-term external source of finance or topic 5 source of finance? No questions? Then we stop here. So I will see you next week, same time. All right. I'll see you next week. Thank you. Bye-bye.